There's a $10 Shanghai premium flashing on silver, and it's been sticking around long enough to stop being a quirky spread and start being a message. Kitco reported Shanghai's silver benchmark fixing roughly $10 above Western spot, and they were explicit. Typical arbitrage hasn't crushed it because the real world has frictions, capital controls, shipping logistics, and access constraints. Now layer on Iran war risk. And I'm timestamping this clearly because high-stakes headlines need timestamps. As of Feb 28, 2026, AP and the Washington Post are both describing joint U.S., Israel strikes on Iran, and retaliation risk across the region. That's the cocktail. And here's the cliffhanger you need to hear right now. If this premium doesn't break on the next Western flush, COMEX doesn't get a vote. Because that's what persistent premiums do in commodities. They don't argue with the screen quote. They quietly tell you where the real bid lives, and then the system eventually adapts. Now, I'm going to explain this in a way that keeps you out of the comment section trap. No conspiracy theater, no villain hunting, just mechanics. And you're getting the whole video in one sentence early, because that's how you keep cold viewers. Here it is. If war headlines keep the market in event mode and Shanghai keeps clearing higher, COMEX either catches up through acceptance on the retest, or the system forces one more volatility snap to clear leverage before it can catch up. That's it. Now you've earned the engagement prompt, not before. One word only. Catch if you think COMEX is forced to rise toward the east. Snap if you think we get one more violent flush first. Catch or snap. Quick guardrails. Short, fast, adult lane. Different feeds print differently in event regimes. Watch behavior, not the exact tick. Premium is a signal, not a prophecy. And event regimes move in phases, liquidation first, hedge later, so don't marry the first candle. Educational only, no advice, no signals. All right, 2 tells decide everything, and I'm paying you early. Tell 1, how does the premium compress? Does it compress because COMEX rises or because Shanghai falls? Tell 2, after the first pullback, do we get acceptance? Or does the move fail once the market becomes tradable again? If you can track those 2 tells, you don't need a narrative. You need a read. Now let's earn the title. COMEX catches up. Because most people hear that and imagine a clean breakout. That's not how commodities resolve. Commodities resolve through incentives, and the market doesn't reprice because the story becomes convincing. It reprices because the current price stops clearing supply and demand across regions, and because the cost of maintaining the disconnect becomes too high. That's what a persistent $10 premium is, a cost signal. Now, what does a $10 Shanghai premium actually mean in plain English? It means there is a venue in China where silver is effectively clearing about $10 above the Western reference quote. Kitco's piece is important because it doesn't hype. It explains why the premium can persist. Restrictions and frictions can keep arbitrage from instantly equalizing prices. And this is where people lose the plot. They see a premium and they jump to one of 2 lazy camps. Camp 1, West is fake. Camp 2, paper sets the price, premium doesn't matter. Both camps are missing the adult answer. A persistent premium is what you see when the world is not frictionless. Arbitrage isn't a magic spell, it's a business. It needs capital access, permissions, timing, logistics, hedging, and reliable settlement. If those constraints are real, and Kitco is explicitly telling you they are, spreads can persist. So the premium isn't proof of manipulation. It's proof of friction and localized urgency. And localized urgency tells you where marginal physical demand is clearing. That's why I'm calling it a message. Now you might ask, okay, but why does Iran war risk matter for whether COMEX catches up? Because war risk changes the entire behavior regime of markets. In a normal week, spreads can sit there and people shrug. In an event regime, spreads become pressure gauges, and if the pressure gauge doesn't relax, the system has to adapt. Now, let's be precise about what event regime means here. As of Feb 28, AP is describing Russia condemning joint U.S.-Israeli strikes on Iran, warning of regional consequences, and describing the action as a significant escalation. The Washington Post is reporting Iran promising a crushing response, describing heightened base vulnerability and the broader military posture in the region. Whether your personal politics agree with any of it doesn't matter. The tape is pricing it as event risk, and event risk does 2 things immediately. It increases the value of liquidity, and it increases the value of hedges. So markets move in phases. Phase 1 is often liquidation, cash first. People sell what they can. That includes things they believe in because survival beats belief. Phase 2 is hedging and safety. Hedge later. That's where gold gets the clean bid and silver, being thinner and more volatile, can move violently. So in an event regime, you can absolutely see silver spike, dump, then spike again. That's not weird. That's phase behavior. Now, where does Shanghai premium sit inside that phase model? Here's the key. Premium persistence during sell-offs is the tell that physical demand is not loosening, because in a normal market, a big paper sell-off relieves stress, premiums compress, sellers show up, supply appears. If paper sells off and the premium stays stubborn, it means something is different. It means the paper sell-off is not creating physical selling, and when paper sell-offs don't create physical selling, the system is being pressured into repricing or into forcing behavior changes. Now, I want to bring COMEX into this, carefully, because you specifically asked for COMEX catches up. The reason COMEX has to catch up in some scenarios is not because COMEX is wrong morally. It's because COMEX is a liquid paper reference that can diverge from physical clearing signals. When that divergence persists and becomes expensive, the system adapts. One way it adapts is by COMEX moving higher toward the physical clearing price. Another way it adapts is by physical loosening and the premium compressing from the top. So the first tell you watch is how the premium compresses. This is the simplest way to track this story without turning into a spreadsheet addict. If Western price dumps and Shanghai won't budge, that's not normal. That's your first warning line. Now, a practical tool, if you want to track the Shanghai premium consistently without reinventing the wheel, Metal Charts has a page that tracks Shanghai silver price versus US spot and monitors the premium. Consistency matters more than perfection. Pick one source and track it daily for a week. You're not trying to win a debate, you're trying to detect persistence. Now, let's anchor one more physical stress signal without overclaiming. Kitco's February 11. COMEX depository statistics cited a single-day negative adjustment of 3,256,882 ounces in registered silver, dropping total registered below 100 million to 98,138,005 ounces, plus more withdrawals from eligible. This matters because it frames the broader environment. The market has been watching deliverable availability tighten. I'm not going to pile on extra real-time numbers from random trackers here because you're right. That invites skepticism. The clean approach is use Kitco's cited COMEX figure as a documented anchor. Use CME's daily warehouse depository reporting as the canonical primary source when you check the exact current number. Then focus on behavior, spreads, premiums, retests, and delivery behavior. Now let's do the second tell. Acceptance on the retest, because this is where traders get wrecked. People chase the first candle. Event regimes punish that. So here's the method that keeps you alive without requiring me to invent ticks for your feed. Go to the 1-hour chart. Find the impulse candle that drove the move after the event headlines hit, the candle that expanded range and broke out of prior chop. Mark 2 lines. Line A, that breakout candle's body close. Line B, the midpoint of the impulse move. That zone is your acceptance zone. Now the rule that turns this into something you can actually execute, I only respect continuation if we print 2 hourly body closes holding that zone after the first pullback, after the market becomes tradable again. 1 candle is noise, 2 closes is acceptance. That rule alone will save you from 80% of fakeouts, because in event regimes, the first move can be a headline spike, a squeeze, a short cover, or a liquidity vacuum. It can be all of it at once. Acceptance is what turns a spike into a leg. Now here's where it gets dangerous. Pattern interrupt number 1. Here's the trap that wipes people out. They see $10 premium and war risk, and they assume the move is guaranteed. Then they lever up. Then the market does what it always does in fragile conditions. It clears leverage first. And this is where catch versus snap really lives. Catch does not mean up only. Catch means after the snap attempts, the market holds acceptance and COMEX starts moving toward the higher clearing signal. Snap means the market uses volatility to harvest stops and clear weak hands first, before any sustainable catch-up. Now, to understand COMEX catches up, you need to understand what can close a premium. There are only 2 clean closure paths. Path A, COMEX rises faster than Shanghai, compressing the premium from the bottom up. Path B, Shanghai falls faster than COMEX, compressing the premium from the top down. Only Path A is COMEX catching up in the way most people mean it. Path B is Shanghai loosening. So tell nor 1 is literally which path is happening, and you can see it without being a genius. If Shanghai stays firm and the premium compresses, COMEX is catching up. If Shanghai collapses and the premium compresses, the east demand signal is loosening. Now pattern interrupt number 2, if you remember one rule, don't trade the first candle, trade the verdict. You don't need to predict the war, you don't need to predict the premium, you need to see whether the market holds acceptance after the pullback. Now I want to tighten the middle section that becomes lectury and make it punchier. Here's what matters. Shanghai premium is the stress gauge. War risk is the volatility amplifier. COMEX registered drawdowns are the sensitivity backdrop. Everything else is commentary. Now, why does war risk make COMEX catch up more likely in some regimes? because war risk can increase the demand for hedges and immediate availability. If the West tries to price calm while the East keeps paying up, the system gets squeezed from both sides. The physical bid stays strong. The paper quote tries to stay anchored. The gap becomes expensive. Expensive gaps force behavior changes. And behavior changes show up as volatility, as margin changes, as wider spreads, as forced rolls, as dealer terms shifting. That's how commodity systems resolve, not gently. Now let's talk about what catch-up looks like in tape behavior. If COMEX is going to catch up, you will see three things. 1. Sell-offs start failing to follow through. Dips get bought. 2. The retest holds. You get those 2 hourly body closes holding the acceptance zone. 3. The premium begins to compress in the bottom-up way. Shanghai stays firm while COMEX rises toward it. That's the cleanest catch-up signature. Now, what does snap look like? Snap looks like the market doing its favorite event regime move, a spike that pulls in late longs. Then a fast flush that clears leverage, then a rebound that confuses everyone, then another retest, and the retest is where truth shows up. If the retest fails, it was a trap. If the retest holds, it was a transfer. That's why my whole framework keeps coming back to the retest verdict. Now, let's run scenarios. Bearish first, bullish second, because we respect risk. Scenario 1, snap first. War headlines stay hot. Volatility stays high. COMEX tries to rally toward Shanghai, but the first attempt is too crowded. You see a flush that breaks the acceptance zone. You don't get 2 hourly body closes holding it. The premium might still persist, but the West price action can't sustain catch-up yet because the market has to clear leverage. In this scenario, people who chase the first candle get punished. And the most dangerous part is the long-term thesis can still be right, and you still lose money if your timing and sizing are wrong. Now, scenario 2, catch. War risk keeps hedging demand alive. Shanghai stays firm. COMEX tries to flush and fails. The pullback is bought. 2 hourly body closes hold your acceptance zone. The premium compresses because COMEX rises, not because Shanghai collapses. In this scenario, COMEX is being forced to adapt to the higher clearing signal. Now, I want to add the reality check line you asked for because it matters. This is probabilities, not prophecy. The tape tells you which scenario is active. You don't decide it, you read it. Now, the 3-item watch list for the next 24-48 hours, only what matters. 1. Does the war headline regime escalate or de-escalate? AP and WAPO are describing an escalation posture and retaliation risk as of today. 2. Does price hold acceptance on the retest? 2 hourly body closes holding the zone? 3. Does the Shanghai premium stay stubborn on Western sell-offs? And if it compresses, does it compress because COMEX rises or because Shanghai falls? Track it consistently with one source, like metal charts. If those three align, your read is clear. If they conflict, you go smaller or you wait. Now, one more pattern interrupt, because this is where people blow up. The premium is not a buy now button. The premium is a condition. Conditions can persist longer than your leverage can survive. So if you're trading this with leverage, understand the environment. Event regimes are designed to punish you. A correct thesis with bad timing can still bankrupt you. Long-term stackers, your edge is time and discipline. Short-term traders, your edge is structure and risk management. Know which camp you're in. Now I'm going to close the loop with the single most important line in this entire video. The warning isn't the green candle. The warning is what refuses to normalize after the red candle. If Western price dumps and Shanghai won't budge, that's not normal. If the premium refuses to compress on the next Western flush, that's your answer. Now we close OG style with 3 takeaways, labeled and replayable. Premium, war, verdict. Premium. A 10 Shanghai premium has been reported and explained as persistent due to real-world frictions, not instant arbitrage. And you can track the premium consistently over time with a dedicated Shanghai premium page like metal charts. WAR. As of Feb 28, 2026, AP and the Washington Post describe joint U.S.-Israel strikes on Iran and elevated retaliation risk, an event regime that amplifies volatility and makes moves non-linear. Verdict. Don't trade the first candle, trade the retest. 2 hourly body closes holding acceptance after the pullback is continuation odds. Failure to reclaim is snap, flush odds. Catch or snap. Pick one. Then come back after the retest and tell me which one printed. Logic over hype, always.